Ever wonder how some companies just, I don't know, always seem to crush it? Like they just have this knack for winning year after year. Was the secret, right? What makes them so much better than everyone else? Well, in this deep dive, we're going to break down the fundamentals of strategic management and try to answer those very questions. We're pulling our insights from Hit M Strategic Management Concepts and Cases, 13th edition.
You know what I find really interesting? This whole idea of how companies achieve and sustain, that superior performance. It's not just some abstract theory for CEOs and MBAs. This stuff matters, whether you're trying to understand your own company's strategy, or maybe you're sizing up the competition, or even if you're just a curious mind who wants to know how the business world really ticks. I think these core principles, they give you a really powerful way to look at things. So our goal here is to distill the essence of this strategic management knowledge base. We want to give you a clear, concise understanding of what truly sets those winning companies apart without getting bogged down in all the academic jargon.
You think of this as your all-access pass to the strategies of, the real heavy hitters in the business world. We're sifting through this really comprehensive guide to bring you the most impactful ideas, the fundamental concepts that empower firms to not just play the game, right, but to win it consistently and build something that lasts.
Okay, so how does the book suggest we start wrapping our heads around these winning strategies? Where's the starting point?
Well, they start by laying the groundwork with something called the resource-based view. And this perspective, it basically says that a company's strategy should be built on its unique strengths, right? Like what gives it a competitive advantage, especially when it's operating in an industry that has some really attractive opportunities.
That's interesting. So it emphasizes looking inside the company to find its competitive edge.
Exactly. But there's a catch. Just having a lot of something isn't enough. Like, if every company in your industry has the same resources, well, no one has a real advantage.
Yeah.
Oh, and one other quick point. The book also mentions something called the I/O model. And that's basically a way for companies to assess how attractive an industry is by looking at things like its structure and the competitive forces at play.
Right, right. Not all industries are created equal. So how does a company know if it's got that special something, that resource or capability that can really give it a leg up?
Well, according to the book, there are four key criteria that separate, the average stuff from the truly valuable. They call it VRIO.
VRIO. Okay, I like it. It's catchy. So first up, the resource has to be valuable. The book actually defines this as the ability of a resource to enable a firm to exploit opportunities or neutralize threats in its external environment. And that's a direct quote. So basically, it needs to have a real impact on the company's ability to succeed in the face of competition.
Got it. So it's not just about having something unique. It's got to be something that actually moves the needle. What's next?
Second, it needs to be rare. Can't be something that everyone else in the industry has, right? If everyone has access to the same key resources, well, it's just the cost of doing business. Doesn't really give anyone a significant edge.
Right. Makes perfect sense. It's got to be something special. Okay, what else?
Third, it needs to be costly to imitate. Even if a resource is valuable and rare, if competitors can easily get their hands on it, copy it, or create their own version, well, your advantage is going to disappear pretty quickly. Think about a company that has a unique, socially complex organizational culture. That's not something you can just buy or easily replicate, even if you recognize its value. It's built over time.
So you're saying it's not enough to just be different. You also got to be hard to copy. Okay, what's the last one?
The fourth criterion is that the resource should be non-substitutable, meaning competitors can't just find another way to get the same result, right? No workarounds. If they can find an equivalent alternative that gives them the same benefits, your competitive advantage is weakened. So it's really all four of those things working together.
VRIO. I'm going to remember that. Okay, we've talked a lot about resources. What about stakeholders? What exactly does that term mean?
In the book, they define stakeholders as, let me see if I can get this right. Individuals, groups, and organizations that can affect the firm's vision and mission are affected by the strategic outcomes achieved by the firm and have enforceable claims on the firm's performance.
So it's a pretty broad group. We're talking everyone from customers and employees to suppliers, investors, and even the local community.
Exactly. And the book argues that it's really important to manage those relationships carefully.
Why is that?
Well, stakeholders have power, and that power comes from their ability to, withhold those essential contributions that the firm needs to survive, compete, and turn a profit. Let's say, for example, some key customers decide to go with a competitor. Or imagine a critical supplier has problems and can't deliver those essential components on time. These things can have a huge impact on the business.
So it's all about keeping everyone happy.
It's more than that. The research actually shows that firms that are good at managing stakeholder relationships, they tend to perform better.
Interesting. So it's not just good ethics, it's good business.
Right. And they make a really interesting point. The book argues that strong stakeholder relationships and a positive reputation that comes from treating those stakeholders well, that can actually be a significant source of competitive advantage that's really tough for competitors to copy. Think about companies known for going above and beyond for their customers or treating their employees exceptionally well. That reputation, that's a real asset.
So it's not just what you have on the inside. It's how you manage those relationships on the outside, right? Okay, let's zoom out a bit now. What about the different levels of strategy within an organization? The book outlines a few, right?
Yeah, you've got corporate level strategy, business level strategy, and cooperative strategies.
Okay, so let's start with corporate level. What kinds of decisions fall under that umbrella?
This is the big picture stuff. We're talking about the overall scope of the company, like what businesses should we be in? How do we manage all these different pieces? Chapter 6 dives deep into all this, but basically, it's about making decisions that affect the whole enterprise.
Like what? Give us some examples.
Well, a major one is diversification. Should we expand into new product markets? Chapter 7 really gets into that. Or should we go into new geographic markets? That's the focus of Chapter 8.
Makes sense.
Corporate strategy also includes things like mergers and acquisitions, restructuring, and how the company approaches international markets. And, and here's an interesting thing, cooperative strategies. That's where companies form alliances, right? And that can also happen at the corporate level. We'll be digging into that more in Chapter 9.
Interesting. So corporate level is all about the grand plan, the overall direction. What about business level strategy?
That's where we zoom in on how a company is going to compete in a specific industry or market. Think about it like this. You've decided what game you want to play at the corporate level. Now, at the business level, you got to figure out how you're going to win that game. Chapter 4 is probably going to get into this in more detail. But, it's all about defining your competitive position. Do you want to be the low-cost leader? Do you want to differentiate your products or services? Or maybe some combination of both?
So that's where the rubber really hits the road. It's how you actually battle it out for customers in a specific market. Now, you mentioned cooperative strategies a minute ago. How do those fit in?
Yeah, so cooperative strategy, they actually can play a role at both levels. At the corporate level, you might form alliances to diversify into new industries or maybe create synergies across different business units. But at the business level, they're more about strengthening your position in a particular market. Maybe you partner with a company that has complementary resources, or maybe you share knowledge, or something like that. Chapter 9 will give us the full rundown on all the different types of cooperative strategies. But the key takeaway is that they can be a powerful way to enhance your competitive advantage.
Okay, so we've got the internal stuff, the resources, and we've talked about the external stuff, the stakeholders. And we got these different levels of strategy. But the business world, it's not exactly a calm and peaceful place, is it? It's dynamic. And the book talks about something called competitive rivalry. What is that exactly?
Yeah, it's a constant struggle. Competitive rivalry, it's essentially the back and forth between companies as they try to maneuver for an advantage. Think about it like a chess game or, I don't know, maybe a fencing match. Especially in industries with a lot of players, there's this constant maneuvering as each company tries to outmaneuver the others.
Sounds exhausting. Why is it so important to understand?
Because it determines whether a firm can achieve a competitive advantage and, more importantly, whether it can sustain it. You might come up with an amazing new product, but if your rivals can react quickly and effectively, your lead might disappear in a flash.
Right. So you've got to be thinking a few steps ahead, anticipating what your competitors are going to do.
Right. And the book introduces these concepts of market commonality and resource similarity that are helpful in analyzing your competition. Market commonality is basically how much your firm and a competitor overlap in the markets they serve. The more markets you both compete in, the higher the market commonality, and the more likely you are to butt heads, so to speak. Resource similarity is about how similar your resources are to a competitor's. So the idea is if you're competing in many of the same markets and you have very similar resources, well, you're probably going to be pretty fierce rivals.
So you're saying it's almost like you're looking in a mirror at your toughest competitor.
Exactly. The book also talks about something called the likelihood of attack and the likelihood of response. The likelihood of attack, well, that's influenced by a few things, like if you're a first mover, will that give you a huge advantage? Or how big is your company? Smaller companies might be more nimble, but they might not have the resources to sustain a big attack. And when it comes to responding to a competitor's moves, a really key factor is the actor's reputation. If a company has a history of reacting forcefully, competitors might think twice before making an aggressive move.
Interesting. So your past actions can actually influence how your competitors behave in the future. It's like you're building a reputation as someone who's not going to back down.
Yeah.
Now, the book also dives into something called market cycles. There are slow cycle markets, fast cycle markets, and standard cycle markets. What are those all about?
Yeah, they actually have a huge impact on how companies compete. So, slow cycle markets are often industries with strong patent protections, or maybe they rely on unique resources. Pharmaceuticals are a good example. Competitive advantages in those industries can often last a long time because it's really hard for competitors to just jump in. So, the strategy there is often to protect those proprietary advantages. Like you've built a fortress, now you've got to defend it.
Makes sense. What about fast cycle markets?
Fast cycle markets, well, they're basically the opposite. Think consumer electronics or fashion, lots of innovation, but those advantages get eroded pretty quickly because competitors are good at imitating. So the key in those markets is to create a constant stream of temporary advantages. You've got to be super innovative and really good at adapting. It's less about building a fortress and more about, I don't know, maybe surfing a wave.
Riding the wave of innovation.
Exactly. Then you've got standard cycle markets, which are kind of in between. They're not as slow as pharmaceuticals and not as fast as, smartphones. The auto industry is a good example. Advantages in those markets can last for a while, but you've got to keep improving your products, building brand loyalty, and trying to get those economies of scale. It's more about maintaining a competitive edge through solid execution and incremental innovation.
Okay, so those market cycles really shape the competitive landscape. Makes sense. Now, let's talk about how companies grow. The book spends quite a bit of time on diversification strategies. What are the main ways a company can diversify?
Diversification is basically just when a company is competing in more than one business or industry. And there are a bunch of different ways to do it, but the main distinction the book makes is between related diversification and unrelated diversification.
So, related diversification first. What's that all about?
With related diversification, you're expanding into new businesses that are somehow connected to your existing operations. Maybe they use some of the same resources, capabilities, or target similar markets. The whole idea is to create something called economies of scope, which basically means that by operating in related businesses, the company can be more efficient and lower costs than if those businesses were run separately.
And even nonprofits can benefit from this kind of strategic thinking.
Yeah, the book actually mentions that. Makes you think.
It does. Okay, so within related diversification, there are a couple of different flavors, right?
Right, there's related constrained diversification and related linked diversification.
Okay, those are a mouthful.
Yeah, so related constrained diversification is when the different businesses within a company, they actually share a lot of activities. Think manufacturing, distribution, marketing, that kind of stuff. Like imagine a company that makes both shampoo and conditioner. They can probably use a lot of the same manufacturing plants and distribution channels, right? So that's related constrained.
Okay, so there's a lot of overlap. What about related linked?
With related link diversification, the connection is more about transferring those really unique skills and knowledge, the core competencies, into new but related businesses. Those businesses, they might not share a lot of day-to-day activities, but they can leverage the parent company's strengths.
Okay, so give us a real world example.
The book uses Amazon as an example, and they really illustrate both operational and corporate relatedness. I mean, think about it. Their whole logistics network, which they built for online retail, now supports AWS, their cloud computing service, and their grocery delivery. They're using that expertise in all sorts of different areas. Even the Whole Foods acquisition, that makes sense in this context. They're bringing their e-commerce and logistical expertise into the world of, well, brick and mortar grocery stores.
So it's about finding new ways to use what you're already good at. Smart. What about unrelated diversification? When does that make sense?
Unrelated diversification, that's when you go into businesses that have no real connection to your core operations. And the main reason companies do that is for something called financial economies. So basically, if one part of your business is doing really well, you can use that cash to invest in other promising areas. And sometimes you can do that more efficiently than the public markets can.
And we see that with companies like Berkshire Hathaway and SoftBank, right?
Exactly. Those companies are basically holding companies with a really diverse portfolio of businesses that are often totally separate from each other. It's almost like they're venture capitalists, just moving money around and overseeing the performance of all those different businesses. So, related diversification is about synergy and shared capabilities, and unrelated is more about financial management across a bunch of different businesses.
Got it. Makes sense. Now, we've talked about growing organically and through diversification, but what about mergers and acquisitions? What's the difference there?
Well, an acquisition is when one company buys a controlling interest in another, or maybe even all of it, and they either integrate it into their operations or maybe they run it as a separate subsidiary. A takeover is basically a hostile acquisition. It's when the target company doesn't want to be bought.
Yeah, we see a lot of M&A activity in a lot of different industries.
All the time. The book points to the Broadcom-Qualcomm situation as an example of how intense this can be. Broadcom, they've grown a lot through acquisitions, and they were trying to buy Qualcomm, which had also been doing some acquisitions of its own. They eventually withdrew their bid, but it just shows you how much strategic maneuvering is happening in a lot of industries.
Right. And these acquisitions can be a really fast way to, expand, acquire new technologies or enter new markets. But the book also says that these deals, even when they look good on paper, they don't always work out right.
That's a really important point. A lot of M&A deals, they just don't deliver. One common reason is integration difficulties. You're trying to blend two different cultures, systems, processes. That can be really tough. Plus, you might not do your due diligence properly and overpay for the target company. And then there's debt. Sometimes companies take on a ton of debt to finance these deals, which can cause other problems down the road. And of course, you've got the classic problem of not realizing those synergies that you were hoping for. Plus, some companies just get too focused on doing deals and forget about running their core business.
Yeah, makes sense. So what can companies do to improve their odds of success with M&A?
The book emphasizes due diligence, which is basically just doing your homework. You need to thoroughly vet the target company's financials, their strategy, their culture, their people. You also need to have a clear plan for how you're going to integrate them into your company. And really importantly, you need to make sure you have enough financial wiggle room to actually make the deal work without taking on too much risk. That often means having enough cash or manageable debt levels in both the acquiring and the target companies. Often you see successful acquirers paying down that acquisition debt quickly by selling off some of the assets from the company they just bought.
So it's really important to think about what happens after the deal is done, not just the deal itself.
Yeah.
Now, sometimes companies need to get smaller or maybe fundamentally change how they're structured. That's where restructuring comes in, right? What are the main types?
Restructuring is basically when a company makes big changes to its business portfolio or its financial structure to try and improve performance. And there are three main types that the book discusses: downsizing, downscoping, and leveraged buyouts.
Okay, so let's start with downsizing. That seems pretty straightforward.
Downsizing is usually about reducing the number of employees and sometimes shutting down operating units. But it's important to understand that when we talk about downsizing as a strategic move, it's a deliberate decision to become more efficient and profitable. It's not the same as when a company is in decline, when they're forced to cut back because they're struggling. Companies that downsize strategically, they're making intentional choices to achieve specific goals.
Okay, so it's more about right-sizing the company for the current situation.
Exactly. Now, downscoping is a little different. It's a more significant reduction in the scope of a company's operations. This might involve selling off, spinning off, or even just completely shutting down business units that aren't really aligned with the company's core competencies. It's about getting rid of the distractions and really focusing on what the company does best.
It's like trimming the fat, getting lean and mean.
Yeah, exactly. And then there's leveraged buyouts, which are often called LBOs. That's when someone, maybe the management team, maybe the employees, maybe an outside investor, they buy all of the company's assets, usually using a lot of debt. And that's where the leveraged part comes from. The company usually goes private. And the new owners, they often make big changes to improve efficiency and generate cash flow so they can pay off that debt. And often the goal is to eventually take the company public again, or maybe sell it for a profit.
So it's kind of like taking the company private, giving it a makeover, and then putting it back on the market, right?
That's one way to think about it. And there are a few different types of LBOs. You've got management buyouts, where the existing managers lead the acquisition, employee buyouts, and then whole firm buyouts, where an outsider, like a private equity firm, takes over. The book says that research has shown that management buyouts, the MBOs, they often lead to downscoping, a sharper focus, and improved performance.
It's almost like taking the company private can unlock some entrepreneurial energy that was maybe missing before. Okay, let's shift gears again and talk about competing internationally. What does it mean to have an international strategy?
It's pretty simple. It basically means selling your products or services in other countries. Now, some companies are more globally diversified than others, like Netflix. They operate in a ton of different countries. Other companies are more focused. Maybe they're in just a handful of markets.
And the book talks about something called a transnational strategy. What's that?
That's a really interesting one. It's basically trying to achieve two things at the same time, which can be pretty challenging. The goal is to be globally efficient, so you're keeping costs down by standardizing your operations as much as possible. But you also want to be responsive to local needs, which means adapting your products or services to fit the specific preferences in different markets.
So how do you do both of those things at the same time?
That's the trick. The book calls it flexible coordination, which essentially means finding a way to integrate your global operations while also allowing for local adaptations. It's a delicate balance. But if you can do it well, the research suggests that it can actually lead to better performance than just focusing on one or the other.
It's like global scale and local touch. Okay, what are some of the ways that companies actually enter international markets?
There are a few common ways. Exporting is often the first step. That's where you just produce your goods domestically and sell them overseas. Then there's licensing, where you give a foreign company the right to use your intellectual property, like a patent or a trademark, in their market. And there are strategic alliances, where you team up with a foreign company. This can be a good way to share resources and expertise, especially if you're new to a market. Acquisitions, which we talked about earlier, can also be a way to get a foothold in another country really quickly. And then there's setting up a new wholly owned subsidiary. That gives you the most control, but it's also the most expensive and risky.
So companies have a lot of options when it comes to going global. Now let's go back to cooperative strategies. We talked about them earlier, but what are some of the different types?
At the most basic level, cooperative strategies are just about companies working together, sharing resources, and trying to create a competitive advantage through partnership. At the business level, the focus is often on improving your position in a particular market. One of the most powerful types is the complementary strategic alliance, and those are particularly effective when you're talking about vertical alliances, which is when companies at different stages of the value chain work together. So maybe a manufacturer partners with a distributor. Those types of alliances, they often create some really unique advantages that are hard for competitors to copy.
Okay, what about when direct competitors team up? Does that ever happen?
Yeah, it does, and it can be more complicated. Those are called horizontal complementary alliances. And while they can create benefits like economies of scale or maybe some knowledge sharing, there's always that underlying tension because ultimately those companies are still competitors. Think about two airlines that decide to cooperate on, I don't know, baggage handling or something, and that might make sense, but they're still competing for passengers.
Yeah, the frenemies. Okay, what about cooperative strategies at the corporate level?
At the corporate level, cooperative strategies are often used as a way to diversify without having to grow organically or do a merger or acquisition.
Mhm.
There are diversifying alliances, where companies team up to enter new markets, synergistic alliances, where the goal is to achieve economies of scope across different business units. And then there's franchising, which is a really popular model in a lot of industries. One of the big advantages of these corporate level alliances is that they offer a lot of flexibility and they don't require as much investment as a merger or acquisition.
And then there are alliance networks. What are those?
So as a company builds all these different partnerships, it starts to create something called an alliance network. It's like a web of interconnected relationships. And the real power of an alliance network is that you get access not only to the resources of your direct partners, but also to the resources of all their partners as well. It's like
Mhm.
this network effect where you're tapping into a much broader pool of knowledge and opportunities.
So the more connected you are, the stronger you become.
Yeah.
Okay, let's talk about innovation for a minute. The book really emphasizes the importance of innovation, and it talks about the idea of developing innovation as a core competence. What does that mean?
Yeah, innovation is absolutely critical for most companies to survive and thrive. And when we talk about developing innovation as a core competence, what we mean is that the company has figured out how to generate and implement new ideas, new processes, new products, new services consistently. It's more than just a one-off breakthrough. It's about having a culture and structure that just encourages and facilitates continuous innovation.
The book uses Boeing as an
Yeah.
example, right?
Yeah, Boeing's a great example. They've always been known for their commitment to innovation, both incremental, like making their existing planes better, and radical, like developing entirely new planes, like the 787 Dreamliner. That commitment to innovation has been a huge driver of their success. And I think it's a good reminder that to be really successful, most companies need to find ways to consistently bring new ideas to the table and translate those ideas into tangible products and services that create value for customers.
And speaking of value, the book really stresses the importance of creating value for customers. How does that play into a company's overall strategy?
It's really the foundation of everything. How a company plans to create value for its customers. That dictates its entire business level strategy. And we talked about this earlier, but a company can create value by offering lower prices than its rivals, by differentiating itself through unique features or superior quality, or by taking a hybrid approach. But to be effective, those business level strategies, they have to leverage the company's core competencies. And it's not enough to just be good at something today. You have to be thinking about how those capabilities need to evolve to create value in the future.
So you're saying it's a dynamic process. You've got to constantly be adapting and improving.
Exactly. And finally, the book talks about something called the integrated cost leadership differentiation strategy, which is basically trying to do both at the same time. Keep costs down and offer unique differentiated features. How do companies make that work?
That's a great question. It seems kind of counterintuitive, doesn't it?
Yeah, it definitely can be. The book says that companies that do this well, they're usually really good at adapting to new technologies and changes in the external environment. Because they're trying to do two things at once, they have to be good at a lot of different things. And often that means relying on really strong partnerships to supplement their own capabilities. But if they can pull it off, they can be incredibly adaptable and resilient.
Okay. As we wrap things up here, what are some of the key takeaways you want our listeners to remember about strategic management?
Well, I think it all starts with understanding the importance of resources. If you don't have valuable, rare, hard to imitate, non substitutable resources, you're not going to build a sustainable competitive advantage. That's fundamental. And then it's about managing those relationships with stakeholders. You can't succeed without them. We also talked about the different levels of strategy and how important it is to make sure they're aligned. And then, of course, understanding the dynamics of competitive rivalry, how those market cycles work. And finally, innovation, innovation, innovation. If you're not innovating, you're falling behind.
Yeah, those are all great points. As you're listening to this, think about the companies you interact with, the ones you work for, the ones you compete with, even just the companies you buy things from. What makes them tick? What are the sources of their competitive advantage? How do they manage their stakeholders? What kinds of strategic decisions are they making?
Exactly. And here's something to think about as you go about your day. In today's world, everything is changing so fast. Technology is disrupting everything, and competition is more global than ever. So the question is, how is the idea of competitive advantage itself changing? Are those traditional things we talked about, the value, the rareness, the inimitability, the non-substitutability, are those still the keys to success? Or are there new factors emerging that are becoming even more important? It's something to ponder.
Yeah, definitely food for thought.